Thank you very much.
Yeah.
First of all, we need to know in general insurance and in general and in health insurance, we have something that we call pool. We're creating a pool of whatever amount that the clients are contributing.
Yeah.
You see, you've paid 200 and you're getting a brand new car equivalent to the value of the first car, right?
Yeah, definitely.
This money, when we are taking comprehensive insurance or car insurance, there are some things to be considered, like perils. You see?
Yeah.
The cause of the accident, that's what we consider. Those are the perils.
Okay.
Like if you for the car, you can say I'm insuring against fire, against maybe accidents, like normal accidents.
Yeah.
Against theft.
Yeah.
Those are the factors to be considered.
To be considered.
And there are so many other people who are taking the same insurance, risk paying for the same perils. But at the end of the day, it might not be all of us who are involved in the same perils.
Okay.
Or the same types of accidents that we've insured.
Yeah.
So this money, it's not refundable, but it's there waiting for that risk to occur.
Yeah.
So I have paid, just like when we were paying NHIF or SHA. I can't go and claim that 6,200
It's a social fund,
But in case
it happens,
I fall sick, I'm admitted, my SHA will pay for
it. It pays.
In case my car is involved now in an accident, my insurance is there to stand for me.
Yeah.
So this money, you were asking, why pay the less and get more?
Yeah.
So the issue is, it is coming from a pool, from so many car owners in the country.
Yeah. Hello viewers, as always I'm your host with the most, they call me Timothy, and I'd love to introduce you to another new session. But specifically today I wanted us to talk about the finances, the decentralized finances, because we are no longer living in an era of centralized financing. But as much as it's affecting us, because I do understand many of us are still banking, and that's one form of centralized finance, but we have to incorporate the centralized finance with the decentralized finance and the regenerative finance. And as of today, I have a guest on board, and I decided to bring a professional on board. Makofi kwangu. But because I understand finances affect us, and we have to get a clear picture when we are saving, even if you don't have much to save with the current economy. But we must have an expert on board to dive deeper. And as always, I'll let her introduce herself and tell us what is her forte and why did she choose that industry. So, karibu sana.
Okay, thank you so much. My name is Sarah Kurui. I'm from Jubilee Insurance. I work as a financial advisor at Jubilee Insurance.
Okay.
So basically, when we hear about insurance, we might think of the health only, the car insurance, the money markets. Of course, those are included, but I want to introduce insurance. It's divided into three. We have the general insurance.
Okay.
We have the health insurance. And we have life insurance.
Okay.
So myself, I work at life insurance.
Life insurance.
As you can see in my t-shirt.
Life insurance.
Jubilee Life Insurance.
And I love how precise it is. I was to ask, why insurance?
Okay, the reason why I chose to work with insurance is because today everyone is facing financial constraints, especially after Corona. COVID hit us so much. Most of us lost their jobs. And if we didn't have anything at hand, of course, most people went back to the village.
Definitely.
But I chose insurance because it opened my eyes, my reasoning, my thinking, my way of saving. And here I am today, working and also advising other people. You need to choose where to save your money.
Okay.
You need to choose and make wise decisions when it comes to finances, because you never know about tomorrow. Life is full of risks. as risks are there to stay, what are you preparing for the future?
Okay.
Are you having that financial freedom? Are you having enough to sustain you till your old age? No, we might not have. Some might have, but it is never late. This is the right time. You can start doing something. You can start saving small towards your financial freedom.
Yeah. Okay, you've been out here, umekuwa kwa ground. So how is the ground? What is the saving culture on the ground? Do people prefer saving for long-term gratification or for future gratification, or do they just enjoy instant gratification?
Okay.
Yeah.
I can say most people just enjoy saving and eating it.
Yeah.
You save small, you withdraw, you take it.
Yeah.
Allow me use that saving and eating it because we don't admire saving for the future. We cannot even we cannot say we are investing for short term. Ours cannot even reach 3 years. We're just doing it today. If need arises, we will withdraw it. We start it again. There's no discipline. We are not intentional in our saving. That's what I can say.
One of the role of this podcast is we don't shy away from keeping it real or keeping it raw or keeping it relevant and keeping it rare because we'd rather feed you the hard truth and you see what to do with it rather than sugarcoating, because as of late we know many people or many industries around or many brands that like to sugarcoat things instead of telling you the real truth behind the truth. Now, for you as an individual, I do understand you have a policy yourself.
Yeah, I have.
Yeah, you do have a policy, and I'm pretty sure it's not even one. You're planning to getting another one. Yeah, because you know the benefits of that policy.
I know the benefit.
Yeah,
because if life is full of risks.
Yeah.
If that risk arises today in my life, what will my beneficiaries enjoy? How will they handle it?
Yeah.
For example, if death occurred today, God forbid, but it's there to come.
It is.
It might not be today, but it might be tomorrow or the following day.
But there's that certainty.
As it comes, how will my beneficiaries live without me? How will my children go to school? How will my family endure without me? Though I'm not saying I'm the breadwinner, but there's something that I can contribute to the table.
Yeah, always there's that part that you play.
But I would wish also to leave my beneficiaries in a better state. Even today, funerals imekuwa gharama. It's very expensive.
Yeah, indeed.
As it comes, how will they start? Where will they start? You fundraise today, you get 50K. Will it sustain?
It can't suffice.
It can't.
Yeah.
So I should also be smart enough to prepare something better. So that this eventuality as it comes, I've already spreaded my risk to someone else. Like insurance, my Jubilee, my insurance is taking care of my risks.
Yeah. Okay, spreading of risk. We were to go there a bit later, but now that you've come there, I think we can just tackle it the way it is. Of the 3 policies that you've said, which one do you find, it might sound off, which one do you find lucrative and is the best for you? And what are the different interest rates involved in these 3 policies?
About the 3?
The life insurance, the general insurance, the health insurance.
Of course, general.
Yeah.
General deals with the cars, the properties. You're insuring your property.
Yeah.
In case of anything.
Yeah.
You're already secured. In case of calamity, in case of accident, the insurance is here to take care of it. But health, I'm sick, I just walk to the hospital and I'm served free. I don't need to go deep into my pocket and get some coins. No, I won't pay. The insurance will pay for me.
Yeah.
Now let's come to life insurance. Life insurance, let's get the difference. It's not about the last expense.
Yeah.
I want to put it clear.
Yeah.
When we're talking of life insurance, we are talking of your own personal financial development goals.
Yeah.
We're talking of your own financial freedom.
Yeah.
We're talking of your own goal achievements, objectives that you've had way back, but you never achieved them.
Yeah.
You've been dreaming over and over and over again. But now, life insurance is telling you, instead of you continuing to dream, let's walk the dream. You see? So in life insurance is basically about developing ourselves. Life insurance is about achieving our dreams, achieving our goals, achieving all that we've decided to have in life. We want that big car. It is achievable.
Yeah, it is.
We start saving towards it.
Yeah.
Kidogo kidogo, kujaza kibaba.
Yeah, definitely.
Let's move towards it.
Definitely.
You don't need to go to the bank and get a loan. Ukishindwa, that car, they will come for the car.
Yeah,
and
as a
you pay
security.
maybe halfway.
Yeah.
Ni hasara kubwa.
Yeah, definitely.
So we need to consider such things when we're doing our own investments. So coming back now to life insurance, you were telling me to differentiate about
between the three. Yeah.
So the first one, the general. General insurance is here to take the risk in case something occurred to your property. They will compensate you. Second, health insurance. Health insurance is here to pay for your medical bills.
Yeah.
Now we come to the third one, the life insurance. You've taken care of the property. You've taken care of the health.
Yeah.
Now how about your financial freedom?
Okay.
You're going to retire.
Yeah.
What will you enjoy when there is no more salary coming in?
And you're in your retirement.
And you've already retired.
Okay.
You see, when retirement comes, it comes with either good things or the pressure comes with it.
Yeah.
Because we are not used to
definitely
staying in the house.
Yeah.
If you're not prepared enough, definitely where will you go? Because the landlord won't sustain you for another maybe 5 years.
Yeah, you just have to go back home.
Yes, you will have consumed everything that was in the
account.
Maybe in the account or that small pension thing that you had kept.
Yeah.
But remember, the pension that you kept, maybe the NSSF, how much, for example, in a normal rating, if you rated a normal standard tu ya ule mtu ameajiriwa na serikali.
I think back when I was employed, NSSF, I used to pay, I don't know if it was 200 or 400 in a month. On a monthly
400.
basis, it was 400. Now, I didn't work for long. I just worked for 2 years, and then I had to call it quits. So I don't know.
Then, okay, we are assuming if you can get, after 60 years, you're getting like maybe 1.5.
Yeah, definitely. It's not much.
It's not much.
It's not much.
And remember, you're used to an urban setting life.
Yeah.
And now you're imagining, I'm going back to the village. How will the village accommodate you?
It can't. And maybe when you're working with the government, it comes with its own pressure because you have to impress certain people and you have to live in a certain kind of setting. Maybe you're living in a 2-bedroom or in a 3-bedroom.
But now you have to face the reality. You move to maybe 1-bedroom.
Yeah, you're downsizing now.
Yeah. Or you either quit to the village.
Yeah. And life is not easy at the village.
It's not. It's even worse.
It's worse. Not even.
It's worse.
It's worse.
So basically, what the insurance is trying to tell us is try to save something small for the future. You see, we've lived today. How about the future? The future is not known, but we are heading there. But as today, the economy is hard as it is now.
It is.
How about tomorrow? It's even getting maybe worse than...
Yeah, definitely.
Harder than today.
It is. So specifically, I get it. The policy that you have currently, is it life, health, or?
Oh yes, thank you. I have the 3.
Okay. Wow. Car
insurance.
Okay.
I have health insurance.
Health insurance, yeah.
Health insurance is provided by the job.
Okay.
But you see, at times, we need to top up.
Yeah.
Depending on my family size,
Yeah.
I have to top up.
Yeah.
Third, and the life insurance. The life insurance that I have, I took a long-term insurance.
Okay.
I took a long-term insurance because I'm projecting at my retirement.
Yeah, definitely. Okay.
When I retire, I will be having grandchildren around me.
Definitely.
They will need a better grandma, a modern grandmother.
Yeah, definitely.
What will I provide for them?
Yeah,
will I
definitely.
take them to the village and be giving
You
them
can't,
crochet and
you can't.
they
You
won't
can't.
take it.
They won't.
They will hate me maybe.
Yeah, definitely.
But I want to retire smartly. That's why I took that a long-term insurance. I took a 15-year plan.
That's beautiful. I'm trying to absorb that picture when you're saying you want to be a smart, a modern grandma. I'm just now imagining myself as a guka.
Yeah.
Then I'm having small grandkids, and life is just smooth because as the Lord permits us to live, we have to live. We have to make life bearable. And how do we make that life bearable? Now, coming to the nitty-gritties. Now, let's say like there's a viewer, a listener who wants to take up on the life insurance because it's about my welfare in future and in the days that are coming. How do I start on a life insurance?
Okay.
Yeah.
Thank you. Life insurance, we only need, first of all, you should be, if you are a Kenyan citizen, you will need your ID.
Yeah.
A copy of your ID, a copy of your KRA PIN, and proof like your bank account details. Yeah, and filling a form. As simple as that.
So what are the premiums and how long is the period of payment, and until when should I start withdrawing or getting my benefits?
Okay, in life insurance, we have short-term and long-term.
Okay.
Policies. And my investment plans.
Okay.
When you're taking a short term, all the projects, all the policies that we have are 5 years. Minimum is 5 years. Maximum is 20. And there are other which can go beyond. When we talk of the annuities, maybe we'll talk about it later at that time. Annuities that's a lifetime plan that you want to be having a cash drawdown at the end of after job. You want to be paid just continue enjoying salary. That's when we talk of annuities, but that is it needs lump sum deposit or lump sum premiums to cater for that. But back to our life, this other insurance, the short term I said is minimum of 5 years.
5 years.
Maximum is 20.
20. Okay.
Yes, you can just gauge yourself. Where am I today? But remember, life is you might see I still have time, but remember the risks that comes about along the way. Definitely. So today, if you choose to take a 5-year plan, you can choose to start with a premium of 7,000.
Okay. On a monthly basis.
7,000 and above. You can hit the ceiling depending on your pocket.
Definitely.
1 million.
You're not limited.
2 million.
You're not limited.
You're not limited to that. For the 10 years plus, you can do the minimum of 4,200. 4,200.
That's the long term.
The long term. Yeah. So in short, when you're taking a life policy, the shorter the period, the higher the premium. The longer the period, the lower the premium. Okay. That is the logic behind it. But you can still choose. You're not limited to that minimum amount that the insurance or the company has stipulated. Stipulated. Okay. But you can still say, I'm taking I want to do it like my pension, my retirement plan. I'll be doing 10,000 per month for the next 15 years. So you see, the returns are there, and you will enjoy more and more returns. insurance.
Yeah. I'm just thinking normally. Even if you think like the short term has higher premiums, but what's the difference between 7,000 and 4,000? 4,000, let's say 4,500. It's just 3,000. Now, if you choose even to pay the policy with the higher premium, it's a plus for you. Because considering even the person who took the long term and is seeing like 4,500 is a subsidized amount, but you stand a better chance of having higher return yields than him. Now, even if you give that period of, let's say we are giving for the short term and the long term, we are giving 10-10, like 10 years, 10 years for you, 10 years for me, and you're the one paying 7,000 for the short term, and I'm paying 4,500 for the long term. For that period of 10 years, you'll be having more money than me.
Of course. Of course. You see, insurance is a game of numbers.
Yeah.
Or any financial institution. It's a game of numbers.
And they say numbers don't lie.
Yes, they don't lie.
People may.
The more you invest,
the
higher the return.
The higher the returns, definitely.
The little I invest, the less
of the return.
It might not, we cannot say it's less per se, but when you compare, the numbers don't lie. When you compare, you're taking 50K per month and I'm taking 10, we literally cannot compare our returns. Even if we're taking the same period, 5 year, yako itakuwa tu zaidi.
Yeah, definitely.
5 times mine.
Yeah. So, now we've already realized the basics of acquiring a policy. We've realized you have to have Kenyan nationality, KRA PIN, and now the
bank account details. Of course, you must be having a bank account because the bank, this is where you will remit your money through.
Yeah.
We are doing either if you work with an institution, we can create a check-off. If we have more than 5 people from an institution, we can create a check-off market whereby the payroll master will be submitting your money direct to the insurance.
So it's like we can fit it in a standing order. So monthly, it's deducted.
Yes, it is deducted. Now the check-off is the SSO. That's the standing orders. We do the standing orders.
The standing orders.
Alternatively, I'm not working. I'm self-employed. We do the DDA. Direct
debit.
It is allowed.
Okay.
So I will just make sure that there is money in my account every month on a certain date that we just identify, maybe the 1st, 8th, 15th, or 25th.
Yeah.
Those are the dates that the insurance company work with because at 25th we consider the business is now for the next month.
Now, on these dates, when a person is to pay now for the DDA, now you're not employed because you're working as an entrepreneur.
Yeah.
Let's say we have agreed on a date to pay. Maybe it's on the 5th, and I delay and I lapse. How do you give a grace period whereby I can lapse with 2 days and then recover, or is there no grace period for paying?
Okay, when you lapse, lapsing.
Yeah.
Per se, when a policy is termed lapsed, it has to have had an arrear for 3 months.
3 months.
That's when you can say now it
has lapsed. Yeah.
Iko kwa ile ICU state. But if you've skipped maybe some days, you can still pay by via M-Pesa. It is allowed. You pay direct to the company via paybill, Jubilee paybill account. So when you pay, it will be captured that you paid for the month.
Yeah.
Yes, I didn't get the money on maybe 5th that we had agreed, or 15th or 25th.
Yeah.
But you pay before first.
Yeah, you can just say the pay bill and we'll indicate it in the video. Just say the pay bill for whoever is watching and maybe the account to be paid. And
the pay bill is 32,8100.
32,8100.
Yeah, that is Jubilee pay bill.
Jubilee
Life.
Bill. Yeah, Jubilee Life pay bill. Okay. Okay. So there's no there won't be any charges for delayed payments, maybe for like a week.
Not really.
Okay.
When we are doing the DDAs, direct debit, remember that the part of you're authorizing your bank to do this on your behalf. For you to avoid the penalties from the bank, why don't we just deposit small by small, or bit by bit? By the time the date is here with us, there is money. Yeah.
Okay, so let's talk about.
But on our side, there's no penalty. As long as you pay.
As long as you pay.
Yeah, even if you pay earlier. Remember, we are our policies are flexible. You can pay monthly. You can pay quarterly. You can pay semi-annual. You can pay annual, or you can pay a single premium.
Okay. So let's say maybe I'm doing a forecast in my business, and I'm seeing like for the next 6 months I won't be having enough sales to cater for the policy, and I have a lump sum now. Is it possible for me to deposit the lump sum and then you'll appropriate it on a monthly basis until the year ends before we go to another year?
It is acceptable.
Okay.
It is very much acceptable. That is where now you as an individual, you've identified your gaps.
Yeah.
That I might not have sufficient funds maybe in the next 2 or 3 months.
Yeah.
Or I'm relocating to a different environment with my business.
Definitely.
Before I settle down, I might affect my policy. Then just pay in advance. Yeah.
Yeah. Oh, that's
pay
beautiful.
3 months, 2 months, 1 year, when the funds are there. You see, when the harvest is plenty, pay in advance. It's acceptable.
That's exactly what I do, because you can't predict. You can't predict how the curve will go. Yeah, that's beautiful. Now, let's talk about these premiums. Let's say I'm already using the short term.
The short term
plan. I'm paying 7,000 a month. For how long will it take for me to be able to start accessing my funds even before the maturity?
Okay.
Is there a leeway in between where I can start?
Yes.
Okay. Can you tell us about it?
All life policies.
Yeah.
When you're taking life policies, at the 3rd year, it is a benefit actually. When your policy is a 3rd year, it enters cash value. When you say cash value, you can access the money, you can surrender the policy that imekuwa mzigo, I can't continue, I want to surrender. But at the third year,
okay,
you can as well take a loan against your policy.
To what amount?
Up to 70%.
Wow. So it depends with how much you've saved.
Yeah.
It will guarantee you, the amount you've saved will guarantee the amount you'll get as a loan.
At 70%.
Okay. So now we can withdraw at the 3rd year.
Yeah.
Or we can even surrender the policy at the 3rd year. Okay.
But normally, I advise my clients.
Yeah.
Why? You took a 5-year plan.
Yeah.
And you're already in 3rd year. You're past halfway. Why can't you just vumilia kidogo, then you get the whole thing? You enjoy the return. But if need arises, kuna zile we can't, hatuwezi tukaepuka. Yes, it's accepted.
Yeah.
You can take a loan or you can surrender the policy at that particular level, depending on the pressure that you have or you are facing as an individual.
When doing a surrender, are there any charges involved?
I said, okay, when we are surrendering, they consider, you remember, when you're taking a policy, we are taking a contract with the insurance. And it is a legal contract.
Yeah.
So when we agreed, we entered a contract of 5 years.
Yeah.
When we terminate along the way, it's like now we are bridging. We're breaching this contract. We are breaching the contract.
The contract, yeah. Just say it.
You see? We are breaching the contract.
Yeah.
So we won't get like 100%. You're disorienting the program.
The program, and you're terminating the contract like midway.
You're disorienting whatever we had planned for.
Yeah.
We had planned for 5 years until we reach 5 years. We get the the whole amount.
The whole amount.
Plus the interest, plus the bonus that comes with
With it.
which has accrued for this period of
time. Yeah.
You see?
Okay.
But we might not take entirely everything. We are taking up to 80%. The 20 now will cater for these other miscellaneous that we to may interrupt the continuation of the program.
Okay, so I'm understanding it in this manner. Now it's like reinvesting. Now I've invested with you guys, and you guys have reinvested the funds somewhere else. Now to recall that investment, you'll have to pay for recalling that investment quite earlier than the period it was supposed to exist. So now when you pay on your side, I also have to pay because I've cut short which is legal. It's legal.
It is.
It's legal.
It is.
I do understand.
Because when you, like now, you took, you gave us as an insurance maybe 10 million.
Yeah.
And in the next 5 years, you're to get over maybe 16 million or whichever. This 6 million that I promised you, I need to labor for it, right?
Yeah.
I need to work for it for me to keep my word.
Yeah.
So the insurance is also reinvesting in other programs.
Yeah.